Alrighty, welcome everyone to tonight's this is the Sunday macro wrap up for Sunday, December 7th. Hope everyone is having a fantastic Sunday evening wherever you are. We have a pretty good show for you guys here tonight. Pretty interesting week coming up as we have the last FOMC press conference, the last Fed meeting of the year. And so we're going to be getting into that as well as some of the data that we had last week that is leading up to this Fed meeting. As you know, over the past couple months, the government shutdown has not been allowing a lot of the hard macro data that the Fed would normally use in order to make more informed decisions. Now, a lot of people say, yeah, even though the Fed has that data, it's mostly backward looking, so they're going to make a mistake anyway. But with the absence of that data, the Fed is even more blind than usual. And so not only have we entered into a tricky scenario where we have inflation remaining, sticky, as well as the labor market deteriorating, but now, it's like they're blind even more. So it's like if you're driving in a snowstorm without any headlights or any type of windshield wipers. So it's just that much harder. So it's a very difficult position to be in for the Federal Reserve as well as the government. Really, the only thing that they can do is continue what they're doing, which is to buy time with basically printing a lot of debt at the government side of things by issuing, billions of dollars in treasury bills and just hoping that the Fed is able to cut rates in time so that the rollover risk does not end up being a problem, which it's starting to be a little bit of a problem here now that they've ran out of tools in order to keep liquidity flowing in the markets. So we'll get into all of that here in this live stream tonight. So if you guys aren't familiar with the Sunday macro wrap up, the way that these work is that they are an hour long. The first 30 minutes are streamed online for our viewers, and then the last 30 to 45 minutes is actually offline for our subscribers that are in our macro investing community. So that is the way that we are going to do this here. So if you guys haven't already, or if you're new to the channel, consider subscribing as well as sharing this with anyone that you know that would appreciate this macro data. So let's go ahead and get into it here with some of the data that we saw from last week, starting with the different signals from the manufacturing side of the US economy versus the services side. So taking a look at this headline here, the United States manufacturing shrinks for the 9th month. Now we got the ISM manufacturing PMI, which stands for Purchasing Managers Index. And so looking at this right here, you can see how we had a pretty low number, similar to how we saw that drop off back in July, but really anything below 50 is considered in contraction. So when we're looking at something like this 50 line, anything below this is essentially in contraction or recessionary for that specific industry. That doesn't mean in the aggregate economy it's a recession, only in that specific industry. And so as you can see, really going back the last 5 years, there's only been maybe a couple times when the PMI has gone above 50, once in February of this year and then another time in January, but really it's remained below 50 since October of 2022. And this is why, part of the reason why a lot of economists were saying, hey, because usually the manufacturing sector leads the aggregate economy or the services economy. And so, a lot of the economists, including myself back in late 2022 and early 2023, I was part of those people, echoing, hey, a lot of this data is showing deep contraction, right, in the manufacturing sector. Typically that translates over into the services economy, which that never happened, right? And that's really what's been fooling a lot of economists, because when looking at the services number, that actually has risen to the most in 9 months. And really the services number matters more than the manufacturing number. But it is interesting, and this is partly due to the large amount of liquidity that was being dumped into the markets from the pandemic, but it's pretty much delayed a lot of these leading indicators by who knows how long, right? Who knows how long, because they dumped nearly $4 trillion into the markets. So yeah, when taking a look at the services ISM PMI, that's actually accelerated back up to expansionary territory. So as you can see, that's above 50. Whereas, from February until just recently, we've had this rebound here. So from March all the way about until September, it was near contraction. I think the only time that it went into contractionary territory was in May of this year. So the real thing to watch is services, and it really hasn't had as bad of a slowdown as the manufacturing. It still has. When looking all the way back to 2021, you can see how this has, you can just look at this visually. It's had a decline here, but it hasn't gone below that 50 mark. And so that's why they say, yeah, the economy has slowed down, but it's really staying resilient in the sector that matters, which is services. And then when taking a look at some of the components of the services ISM PMI, such as the employment number, that has actually increased for 3 months in a row. Now, the employment component of the services index is in contraction, right? So that's below 50. And that has remained below it since, March. So that is part of the leading, I guess, employment numbers. But what's interesting is that when taking a look at the prices index, that actually had a pretty decent decline, even though it's a lot higher than what it needs to be. And so this is kind of playing into the narrative like, hey, inflation could continue to top out here while growth is in an aggregate recovery. And we've been seeing that in the charts as well, which we'll get into here in a second. But some other interesting leading indicators, such as industrial production, that continued to accelerate into positive territory. So when we look at industrial production, that was pretty much in contractionary territory from the beginning of 2023 until just recently this year. So that's partly because of, lowering interest rates. Industry is a very rate sensitive environment. And then also too, manufacturing production has also increased. And then one of the numbers that we got this week in terms of leading indicators is the core goods orders, new orders, and that continues to accelerate here. But then at the same time, we also have new orders of heavy truck sales having a huge drop off to levels that we haven't seen since 2020. And typically, the retail sales of heavy trucks is a very early leading indicator of the economy, and we have not seen a drop off like this in quite some time. So the last time that we did see a drop off like this was obviously the pandemic. We saw that again in 2016, although it wasn't a leading indicator of a recession back then. It did have a pretty quick recovery, which we might see here. But if it continues to decline, this essentially was a leading indicator back in early 2007, the last time that this had a pretty large decline, besides the pandemic. So this is one indicator to keep an eye on. But as you can see, it's a lot of mixed macro data. Some of it is saying it's recovering. Some of it is saying, hey, we should be cautious. Really, though, and this is, also in conjunction looking at the price markets, it's saying that yes, we could see some type of growth acceleration here, but it's really just more fuel to the fire, whereas the hangover on the other side is going to be much worse. Okay, so that doesn't mean go completely bearish on the markets. On the contrary, a lot of the things that my group and I were talking about was getting long specific assets. And although our model went neutral to bearish on the S&P 500 for a single day and then went back to bullish, we weren't necessarily, shorting the market or anything like that, partly because of, the continued narrowing of credit spreads and other things like that, which we'll get into in a second. But it's kind of one of those things where there's mixed macro data, the labor market is still deteriorating, and in the meantime, the markets are still saying, hey, there could be room to continue higher heading into 2026. So don't get too bearish, even though things are definitely brewing underneath. Taking a look at some of the labor market data that we got last week, we got the ADP job cuts, or the ADP jobs numbers. This is the private survey where they only look at private jobs, and that actually declined by 32,000 jobs. And so that's pretty much been in a pretty consistent slowing number for, pretty much since June of this year. And so this was the lowest, I think, since, let me see here. Yeah, this was the lowest since March of 2023. So as you can see, the labor market is still, top of mind for policymakers, as well as the news headlines. Taking a look at the job cuts, so this is the amount of layoffs that happened. We can see, taking a look at the Challenger Gray and Christmas job cuts report, we saw that this was an announcement of 71.3 thousand layoffs in November. Now, on the surface, you say, hey, this is a pretty large decline from what we saw in October. But when taking a look at the report here, which I have the PDF report, this is actually up 24% from the November of last year, right? So you have to remember that typically during November, as well as December, leading up to the holidays, ever since the Great Depression back in the 1930s, a lot of employers have basically come together, and it's like a silent rule, like, it's messed up to fire people before the holidays, right? So typically you don't see too many layoffs during the holiday months, but compared to other Novembers, this was the highest since, or the two higher ones was 2022, which was a pretty bad one, as well as 2008, the Great Financial Crisis. So when just looking at comparing at Novembers, this was a pretty bad one, right? Some of the highlights here. Through November, employers have announced, now this is through the entire year of 2025. Through November, employers have announced 1.17 million job cuts, an increase of 54% from the 761,000 announced in the first 11 months of last year, 2024. Year-to-date, job cuts are the highest level since 2020, when 2.23 million cuts were announced through November, and it is the sixth time since 1993 that job cuts through November have surpassed 1.1 million. You can see these are the dates that this happened last. So obviously, with the jobs market, this is not a good sign. And this is really what's been the focus of the policymakers. Now, I know we just mentioned that previously, but I want to continue to put numbers on it so that you can see exactly what this is. Now, the second point to look at in this announcement report is the hiring plans for next year. So through November, U.S. employers have announced 497,000 planned hires, which is down 35% from the 761,000 announced at this point in 2024. So that's a pretty large decline year to date. This is the lowest year-to-date total since 2010, when 392,000 hires were announced planned through November. So what's also interesting is that when taking a look at the reasons why, so if you scroll down here, you can take a look. They have a table. Let me see if I can find it. Yeah, so here is the job cuts by reason. And as you can see, the top the top four really are market conditions, businesses closing, businesses restructuring, as well as cost cutting. But really the top three have been economic conditions, closing, and restructuring that have been the bulk of it. As well as, year to date, you have the most from the Doge actions, which were mostly, those were mostly government jobs, right? But as you can see, these are not good reasons. Restructuring means, maybe implementing more AI for a lot of these entry-level jobs. Restructuring and closing are obviously, market economic conditions as well as closing are not good signs. But what was interesting was, and this could be because of seasonality, with it being December, there's typically a lot of temporary hiring for the holidays. We did see a pretty large drop-off in initial jobless claims. So I'm guessing that this is because of the holiday season, but that was noted last week. And then lastly, for last week, we got the PCE prices for September, which is pretty crazy. Normally we get the November number, but we're 2 months behind because of the government shutdown. And what we saw was pretty much in line with expectations. The headline PCE number, if it loads here, came in at 3.0%, which was roughly in line with, or 2.8% rather, which was in line with expectations. Again, this is super delayed because it's in September. And then we also saw, looking at core PCE, which that right there is the inflation metric that the Federal Reserve mostly pays attention to. That actually came down from 2.9% to 2.8%. So there was a little bit of optimism that the market saw this week in terms of the inflation numbers. But when taking a look at the Cleveland Fed inflation nowcast, we see that core PCE is set to rise in the next coming months back to 2.9%. So we could see a little bit of a easing here in the next couple of reports, but then a spring back up for the next two reports after that. So we could continue to see stickier inflation numbers from now until they get reported in January. So just keep that in mind. So inflation is still not going away, which is why this is such a hard issue for the Fed to balance here. But getting into some of the policy metrics, leading to this whole Fed decision this week, we had the White House press secretary come out saying, if this will load here, that Trump has taken the most aggressive stance on immigration in U.S. history. The reason why we're citing that is because of since a lot of the immigration numbers have declined, obviously that's a lot less of population in the United States for jobs and hiring. So that's part of the reason why we're seeing, lower jobs numbers. Also, too, when taking a look at this here, the unemployment rate, as well as jobs plentiful minus jobs hard to get, has been accelerating, meaning that demand is slowing. And then also, too, with the whole restructuring aspect going on in a lot of these larger firms, we're seeing the highest unemployment rate for college graduates at 9.3%. And it looks like it's accelerating here. So this is the highest since the pandemic. Yeah, so looking at college-educated job losses rising, the share of U.S. unemployed with four-year degrees is now at the highest number in history. And this is happening at the same time as the birth rate continues to decline. And this right here, this chart is pretty much they say there's an economics saying demographics is destiny. And so with the unemployment rate, or with the birth rate falling off, as well as you're having, essentially zero immigration into the United States. So a lot of immigrants aren't replacing the native birth rate decline. And then you also have the boomer generation getting older and older. You're having a more percentage share going from in the marketplace to retirement, which puts a lot of pressure on Social Security and a lot of government spending there. But also, too, it's shrinking the labor supply. And then also, too, you have the whole onset of AI and a lot of these companies not hiring. And so if you guys remember, just from, basic macroeconomics 101, looking at that supply and demand, equilibrium point where they cross, that has together fallen down. And so you have both supply and demand lower, and it's really just causing a huge freeze. And this is very, very uncommon to see this. Okay, one second. Appreciate that, Sean. Now, when taking a look at this interesting chart here, this is the labor market distribution spider chart from the Atlanta Fed's website. And as you can see, this is comparing the September 2024 number to the September 2025. So last year is green, this year is orange. And as you can see, private hiring is pretty bad. That's near the lowest that it can have. So the outside ring is where you have the best conditions, and the further ring you go inside the spider web here, so this inner ring is almost like the worst labor market conditions that you could have ideally, or not ideally, right? And so as you can see, as the rings start to close into that center, that is showing a worse labor market condition set. And as you can see, private hiring rate, that is near zero. And you're seeing more convergence here. So very low hiring rate, very low quits rate. It's clear that the labor market is in recession right now. But the thing is that would cutting rates and stimulating demand, which would essentially open up the hiring rate, would that actually increase, or would that actually solve this labor problem? Or maybe, these other companies, they say, hey, even though you're lowering interest rates, we don't need to hire any more people because of the restructuring that we're doing. And so you get a scenario potentially where lowering interest rates doesn't actually solve this labor market dilemma, because it's a lot of supply problem, as well as these companies not needing a lot, or needing a lot less personnel. And then also too, with the whole H-1Bs visas, a lot of these companies, if they do need some type of entry-level position, they're just hiring overseas. So there's a real big problem there, and it's so complicated that I don't see how lowering interest rates just fixes the labor market problem. Nonetheless, though, looking at the target rate probabilities for the Fed meeting this week, there's an 88.4% chance that they cut by 25 basis points. So they're definitely going to cut rates. That's what the market has already priced in. But from here, really what we need to be paying attention to is the forward guidance on the press conference, which we're going to go live for starting at 2:15 p.m. on Wednesday. We'll go ahead and run through the report that comes out at 2 p.m. Announcing the rate decision, and then at 2:30 p.m. starts the press conference. But with this specific meeting, we're getting another summary of economic projections report, or what's called the SEP report, which is this right here. The last time that this came out was on the September 17th meeting. Now, the two things that I always scroll to on this 17-page document is one, the SEP here showing the Fed's projection on growth, unemployment, as well as inflation. And if you guys remember from the September print, we saw that they were pricing in more of a stagflationary environment throughout the rest of the year, with 3% PCE numbers, as well as real GDP at 1.6%. Now, from here until 2028, obviously they have that rising, but really staying around 1.8%, which is pretty low compared to the previous 15 years. And then they have inflation really coming down starting next year, and then really coming down in 2027. So we'll see what happens there. And then they also have the unemployment rate coming down as well. Now, obviously, this is ideal. This is what they want. But any type of real economic data that supports these projections, obviously, the market is going to like that, and you're going to continue seeing a bullish market. And really, the Fed has guided to that so far, which is why the market has already priced in this, stickier in inflation. Now, what we also need to pay attention to is the dot plot, which is the voting from the FOMC, the members that are on the committee there. Each one of these dots represents someone who voted. And what we want to see is the dot plot for 2026, if it rises or falls from here, in terms of how many people are voting for the interest rate, as you can see on the percentages on the y-axis here. And what we want to pay attention to is the amount of dissents. So the people who differ from the actual rate that was selected. And so what happens is that, let's say that they cut by 25 basis points, but six people out of the 12, so roughly half, say they didn't agree with it, that they should have kept rates steady. Well, if that happens, that's going to definitely show a lot of uncertainty among the Fed members, which will definitely get interest rates higher. And when I say rates, I mean the 10-year bond yield. And so we need to be prepared for that type of reaction. Now, this is all playing into the no landing, stop go cycle that we've been talking about over the past several weeks, where ever since the beginning of 2023, when they started slowly draining the reverse repo facility and dumping $2.3 trillion dripping into the financial markets, we've had this no landing scenario where we go from a stop phase where things get a little bit fearful. We have a little bit of a correction in the markets where we have a more hawkish Fed. We have fears of rates pausing. Stocks typically have a correction in that environment, and we have hard landing fears or recession fears. And then inflation expectations come down, things start to settle down, volatility comes down. That's typically a buy signal. And then it goes into a more optimistic go phase, which is right here, which is like, hey, inflation is coming down. Maybe the Fed can get a little bit more dovish. Maybe they're going to price in some rate cuts now that a soft landing is, expected, and stocks go up on that. And then once they go up, that increases inflation expectations because things are going up, things are being stimulated again, and then the cycle repeats itself. And so, what's interesting though is as time goes on from 2023, we're seeing this cycle get faster and faster. So before it was like maybe taking 2 or 3 months per phase. Now it's like a couple weeks, which is pretty interesting. And at some point, a hard landing is going to end this cycle. We're going to be going back to the traditional cycle that we see. But as of right now, this is the continuous cycle. I thought that we were done with this back during the tariff tantrum, all the way back earlier this year, but it kept on going, surprisingly. So that's what I am seeing here. There's nothing else other than the FOMC press conference on Wednesday. That's, the biggest catalyst. But yeah, that's all I'm seeing this week here. So all of that to say is that we're getting mixed macro data, and the Fed is set to make a policy mistake, which in the short term, this policy mistake could cause inflation expectations to go up, and it might actually have other things go up, like Bitcoin having a recovery or something like that. But with last week, which we'll get into here in a second with the charts, it was more of a signal of raising cash ahead of this Fed meeting that is very uncertain. And so what I would like to point out on the charts here is that looking at the 10-year U.S. government bond yield, which is the rate at which things like you and I pay for actually track, things like 30-year fixed mortgage rates, credit card APR, that type of thing. As we can see, since they started to cut rates on that September 17th meeting this year, rates are actually up slightly. They're nearly flat, but they are up by about 10 basis points. And so it's not quite as dramatic as the rate hike that we saw from when they started cutting rates back in September of last year. But this is still showing that the bond market is disagreeing with the Fed's decision. And so what's interesting is that, when taking a look at this announcement right here, which pretty much Trump said that they're going to be hiring Kevin Hassett as the next Fed chair, which he's, a real big buddy of Trump's. And if that happens, Trump could get his 1% interest rate, which if that happens, then you could definitely see the 10-year go up if inflation is not handled. Because, you can't have it both ways. You can't have inflation go down while rates are coming down. You can have that, but the only time that really happens is a recession. But you can't have a soft landing with both of those happening at the same time. And so you either are going to cut rates and stimulate the economy a bunch and risk inflation going higher, or you keep rates steady and that continues this grind lower as, we start to get, the time eaten away with this liquidity issue. So it's kind of it's kind of a whack-a-mole situation with rates versus inflation. And so we really want to be paying attention to what the 10-year does on this reaction on the Fed meeting on Wednesday there, because if the forward guidance is hawkish, like if they do another hawkish cut, meaning they cut by 25 basis points, but then they guide in the meeting that we're probably not going to cut more from here. And if we see the 10-year bond yield rise further from there, then that's not going to be what the market wants to see. Because at that point, it's going to be, higher inflation expectations, and we're going to go more into a stop phase again. So we'll see what happens from there. What's interesting too is that the dollar started to break its bullish trend and is now neutral from bullish. We just looked at bond yields. With all that being said, though, we aren't really seeing any type of systemic risks in the market, right? So bond volatility remains in a clear bearish trend. So that's, showing there's not too much risk being priced into the bond market. As well as you have the volatility index of the S&P 500 back, below 16, which is just wild. But as you can see, this is the stop-go cycle right here. Stop, go, stop, go. It's becoming faster and faster, the rate at which the cycle is happening. Natural gas has been a huge acceleration, or has been having a huge price increase over the past week. This has been the major performer in the month of December so far, or really over the past couple weeks. So yeah, natural gas, silver remains the top top performer. Copper, which is also a global demand indicator, is also showing that this is in a bullish trend, which is good for growth as well as inflation. So you're seeing a lot of these other metals also signaling that inflation could have the potential to go up again from here, which again, might be good for things like Bitcoin. Maybe it finally had a bottom. We'll see. But that's really the signal that we were seeing, right? And so when taking a look at Bitcoin, it's still in a technical bearish trend in our model. It did form an immediate term higher low right here. And if it does push up, above where it closed over here on 93,497, then that could be a pretty decent sign for cryptocurrencies. But again, it's a double-edged sword because it also typically infers that inflation is going to possibly accelerate further from here, because Bitcoin loves when inflation's going up. It doesn't like it when inflation is going down. Now, in taking a look at the SPX, the S&P 500 here, this had a pretty impressive bounce, along with other things that were down a lot, such as small caps. And, this bounce, taking a look at our trading range model here, this bounced near the top end of the trading range, and it was pushing it up. And so just looking at the probabilities heading into this week, there's much more room for downside than upside. But as it keeps pushing up, the top end of the trading range, it also increases the odds of new all-time highs. If you guys see the background of my bookshelf, it remains green, so we are still, bullish on the S&P 500. But in terms of risk managing, when taking a look at volume here, let me go to the SPY because it's easier to see. We did have a little bit of a volume acceleration on Friday, but really compared to the average, this bounce here has been on, lower volume. So what I would like to see, or what would make me even more bullish, is if we saw some type of correction to the low end of the trading range this week, maybe leading up to the Fed meeting on lower volume. That would be a huge buy signal. On the contrary, though, on the other side of that, if this continues to push up into the top end of the trading range on continued decelerating volume into the meeting, well, that's just a continued, raised cash signal. And so, yeah, my team and I, we remain net long due to this broadening participation of the markets in this, rebound, as well as the collapse in the volatility index. And so we were raising a lot of cash last week. So we'll see what happens heading into this meeting here. But yeah, I mean, some of the best performers last week too were things that were in that are currently in bearish trend, such as Meta. Cat Remy just wanted to say hi. What's up, Remy? Yeah, so things like Meta are having a bit of a pop last week. NVIDIA remains neutral in her model, so pretty interesting there. Might get a chance with buying some Apple this week. We'll see about that. And I think what also Bitcoin and some of these more liquidity sensitive assets are enjoying is that the rate of change. Remy, don't step on the keyboard, buddy. The rate of change of net central bank liquidity has remained flat really since the end of October, which is kind of similar to when Bitcoin had its bounce or stopped going down as well. So yeah, in terms of Bitcoin, we can go ahead and bring up a chart of this. So yeah, Bitcoin and net central bank liquidity are typically positively correlated. And so if we continue to see a flattening of this or even a bounce, that would be further bullish for Bitcoin. So that's pretty much the report we have today. And so we're coming up a little bit over the halfway point. So from here, we're going to go ahead and switch offline to just the members that are on the Zoom call here, where we're going to be discussing some actual ideas based off what we just talked about and go into a Q&A round. And so for those of you who are on our live streams, just check out our website if you guys would like to join the discussion, offline here. But I appreciate everyone for joining, and we will catch you on next week's Sunday Macro Wrap-Up. Bye, everyone.